Hello, Dr. Tim Creel here. We'll be looking at Chapter 8 here. So let me go ahead and pull up the presentation. And let me go ahead and start the presentation. Okay, so Chapter 8 looks at the acquisition and expenditure cycle. Now, what we're looking at in these in the last chapter and in this chapter, the next couple of chapters, are different cycles that are broken down by auditors to improve the efficiency of the audit. We looked at that last time with the revenue and collection cycle. Because think about it, whenever you would make a sale, you would get revenue, but then you would have to most sales were on credit, so then you'd have to collect that from the customers. And so sales and accounts receivable are very closely related accounts. And the same thing in this chapter that we're looking at acquisitions and expenditures. So the companies have to purchase items. They might be purchasing supplies, they might be purchasing inventory, they might be purchasing large items like, property, plant, and equipment, major items there. But they make these purchases and then they typically do these on short-term credit, which is accounts payable, and then they make payments or pay off that payable then 30, 60, 90 days later, whatever the agreement they have with that supplier is. So again, these two are related because if you make a purchase, you're going to have to pay for it. You're going to typically do it on credit and then you're going to have to pay for it. So again, these are related. So kind of auditing one or verifying one in a way verifies the other or helps verify the other. So again, that's why as auditors, you look at these two cycles together. So the acquisition and expenditure cycle looks at the purchase of goods and services. So you're going to purchase goods and services. Again, they might be inventory, office supplies, they might be larger items, they might be services such as having the lawn mowed. Um, some of the forms that you're going to look at with this would be a purchase requisition and a purchase order from the approved vendor list. So basically, a purchase requisition would be a part of your company sending a form that they've completed to the purchasing department in order to make a purchase. Like if one area decides, well, we need this. So they fill out a purchase requisition and they send it to the purchasing department. Now, most big companies have a purchasing department. And this is a department that gets requests from different areas. And based on those requests, based on budgetary limits, will make decisions as far as can we get that? And if they decide to get it, then they fill out a purchase order and then make the purchase from a vendor off of the approved vendor list. Now, companies need to update their approved vendor list as things happen. Maybe a vendor will no longer be on the approved list, so it'll be taken off. So one of the things as an auditor you'd be looking at is, are they regularly updating their approved vendor list? That would be, in a way, kind of verifying the strength of their internal controls. How often do they update this? Now, a lot of companies have a purchasing department as this helps control kickbacks to purchasing agents. Um, and what are kickbacks to those making the purchase? If everyone could make their own purchases across a company, then basically you could have chaos. But a purchasing department is a separate department that makes these decisions, that makes these purchases. And like I said, if managers were making them in different departments, they might not follow the budget as they should. They could be easily distracted by kickbacks, or let kickbacks help make their decision. But having a purchasing department is a good control because you've got one area making the decisions. They're not connected to these other parts of the company, and they have very strict rules and policies that they must follow as far as gifts or kickbacks or anything like that from outside vendors. So it's a good control in place to have a purchasing department. Now, you would now also then the company would then receive the goods and services. So if the purchase order was was created, sent off, the company made the purchase, the company then is going to receive these goods and services. So most companies have a receiving department, and the receiving department is responsible for looking at the purchase order and completing a receiving report that should agree with the purchase order, and just really just making sure that the company got everything that they ordered. Now, they're going to prepare the receiving report, which is in essence just what did we receive, and they're also going to compare it to the purchase order again, and kind of look for any differences, or you know were any of the goods they received damaged in shipment. They're going to look at things like this in regards to receiving the goods. Now, recording. So basically, kind of think of the cycle as this. It's related to purchasing goods and services. One department would fill out a purchase requisition, would send it to the purchasing department. They would do a purchase order. The company would then receive it in their receiving department, prepare a receiving report, and then they would record the asset and related liability. And then basically at a later time, they would pay off the liability. So that description right there really sums up the main elements of the acquisition and expenditure cycle: purchasing goods, receiving the goods, and recording the asset and liability and paying off the liability. That really sums it up. This slide really sums it up right here. Now, the relevant assertions that you're looking at and accounts that are part of this cycle would be: one would be accounts payable. In accounts payable, you're looking at in terms of completeness. Are the transactions complete? Cutoff, were the transactions recorded in the proper period? Existence, basically, do these liabilities actually exist? Presentation, are they presented properly in the financial statements? And valuation, are they valued correctly on the financial statements? Now, a couple of things I'll say about this real quick is that completeness, you're looking at again, are all the elements of this transaction recognized? If you basically have open purchase orders, or a receiving report that you can't match with other paperwork, that indicates that something could be missing there, that something is not complete in regards to accounts payable. Cutoff, as far as the right period, a big thing to look at as far as cutoff, a big thing to look for as far as cutoff is looking at, again, the period when it was recognized. And a big thing is going to be your you're looking at, how was it shipped? Was it shipped FOB destination or FOB shipping point? Like if it's inventory or if it's goods. If it's shipped before the end of the year, but it shipped FOB shipping point, then the company will own it during that year, because the company will own it during shipping. So auditors tend to look at about the first 10 days of the following year, and they look at any items that came in during those first 10 days of that coming year. Were they shipped before the end of last year? And if so, were they shipped FOB shipping point? That's one of the things they look for, because if so, then they should be included in year-end inventory. Existence, do they exist? Um, and basically, kind of what you're looking at here, and one of the things that you're going to see that you're going to confirm as far as accounts payable is you're going to look some at zero balances. Because if a company's showing a zero balance, what if a liability actually exists there? What if there was actually a transaction to this company? And with liabilities, you're looking more at companies lowering or reporting lower liabilities than they should. And that's kind of what you have to keep in mind as far as your risk assessment with accounts payable. With sales and accounts receivable, it was just the opposite. It was companies listed higher than they should be. But with this, again, it's lower than they should be with accounts payable. Presentation and valuation. Are they presented properly in the right place? And are they valued properly on the financial statements? Now, with expenses, you're looking at completeness. Is the transaction complete? Cutoff. Is the expense recorded in the proper period? And one thing with expenses that you're looking at a lot here as far as cutoff is you're looking at the end of the period adjusting entries. Were they done properly? Again, kind of something you're looking at as far as cutoff, because think about it. The purpose of the adjusting entries is to make everything right before you process the financial statements, to adjust the expenses and revenues before you do the financial statements. Accuracy. Are expenses recognized accurately? In terms of what we're looking at with this cycle, you might recalculate depreciation or amortization, a good thing to look at there. And classification, are the expenses put into the right accounts where they should be? Another thing kind of with expenses would relate to possible impairments. Think about it, impairment is an expense if you recognize it, and relates to assets that are purchased. So impairment might be another aspect of this you would be looking at as well, as far as accuracy. And even in terms of classification, as far as, the assets that are affected. Okay, risk of material misstatements and internal controls. So the risk of material misstatement, you would want to find that for the element. Of course, you're going to identify that in an audit for everything that for basically the entire audit. Risk of material misstatement is always something you're looking at, because it basically determines a lot of things in terms of your audit. The strength of your testing, whether you can do it at interim periods or year end. Um, you know, what is your materiality? The size of your samples. So risk of material misstatement determines a lot of things in terms of an audit. And so you're going to do it for this area along with all other areas of your audit as well. So your internal control activities, these are just some different activities kind of related to internal controls for this cycle. Compare receiving reports with purchase orders. Make sure vendors are on the approved vendor list. Because think about it this way, with the two things here, I'll just start off with talking about these two real quick. The receiving reports and the purchase orders. Basically, this is just the receiving department verifying that the company got what they were asking for. They got what they were ordered. They didn't receive a bunch of extra stuff. They didn't receive, a partial shipment. They didn't receive a lot of damaged goods. That was basically what the receiving report will identify. So it's a good internal control to compare the two. Make sure vendors are on the approved list. A big thing, a big area of fraud is basically selling to someone that's not on, or basically doing business with someone that's not on the approved vendor list. Because basically it's a way to get, and sometimes companies have found that employees are set themselves up as a vendor, and supposedly they're doing business with themselves or overcharging. A lot of things, a lot of fraud cases have occurred related to that. So a good way that a company can protect itself is the approved vendor list. So you as an auditor are verifying or verifying some of these transactions that they're only doing transactions with vendors on the approved list. And you're also looking at how often are they updating the approved vendor list. Compare vendor invoices with receiving reports. Again, the company does not need to pay for something that they did not receive. So the vendor invoice needs to match the receiving report. If they don't, then the company has received too little, or merchandise has been damaged, or something's happened, and the company needs to contact that vendor to update or get a new proper invoice. Verify proper authorization for payment of invoices. This is important. And think about it this way, when it comes to making payments, there's kind of Kind of like I said here in this next thing, verify complete package for payment. It actually, I was about to say that here, but I forgot that I'd put it on the next sentence. So your package for payment should be an invoice from the vendor, a receiving report, and a purchase order. And they should all match. And that's basically put into a package. And then a check will be prepared. And then this will be authorized and signed by someone, who's in charge of AP, who's in charge of accounts payable, and then sent out from there. But a way to verify internal controls is to verify that all of the checks had a complete package and everything matched. And it was properly authorized by someone who has authorization to basically do checks. Separation of duties here in this area. Separate custody of inventory from those who can update the accounting system. And also, I would add here, separate preparing the check from authorizing or signing the check. You want one person to collect the package, the invoice, the receiving report, and the purchase order, and prepare the check. And then you want someone above, in a management position above that, maybe and a lot of times it comes from outside. It could come from the manager of AP, but a lot of times it comes from someone outside of AP, like the controller. A lot of times the controller will do this. They'll receive the package, they'll verify that everything is in check, and then they'll sign the check and approve this payment. So a lot of times that basically is kind of how it comes. So you would be wanting to make sure that this all was being done properly as part of examining the quality of internal controls. You'd want to look at separation of duties in those areas. Now, also here, you want to look for unmatched purchase orders, receiving reports, and invoices. And again, this might go back to the completeness function. This goes back to the completeness function we were talking about earlier. If you have anything out there that's unmatched, a purchase order, what happened? Receiving report, why is there nothing matching it? What happened? Or an invoice, what happened to the goods we received? So um, a big thing here too I want to mention is physical access to assets. You want to put in physical controls and limit access to inventory. When I was a controller, we did that with the company that I worked for. I was a controller for a vending company, and we had pallets of Snickers bars and Cokes and all that in this one area, and we put fencing or like walls or fencing. We walled off that area with fencing to the ceiling, and the only people allowed in there were the people that pulled the orders for the drivers. From accounting, I could go in there to verify inventory counts. And so occasionally we would go with them to verify their inventory counts. About 2 or 3 times a year, we would. It was, as a controller, I did some internal audit functions as well as being a controller. And so I would do that 2 or 3 times a year. And so limiting physical access to inventory is a very good control. We figured that it probably saved us 5 to 10%, because otherwise we'd have people just walk through there. Oh, I'm going to grab a Snickers this afternoon. I'm kind of hungry. I need a snack. Or I've got something going on at my place. I'm going to grab a case of Cokes, this weekend. So, it was a very good control to have in place. And periodic inventory counts, kind of like I was mentioning earlier, that we would oversee the inventory counts in that area, about 2 or 3 times a year. It's very good to have periodic inventory counts. And it can also be done by an outside company. Um, when I was much, much younger, I worked for a company that would count other companies' inventories, and we'd use scanners and we'd use to scan barcodes, or we'd just do counts, and we'd have almost kind of like a 10 key like with us, and we'd be doing counts of different products, and coming up with like dollar values of inventory. And so it was something that companies need to have periodic inventory counts. Most companies would do it like twice a year. I think Walmart does it like every quarter. And by doing a periodic inventory count, if there is theft, if there's unexpected amounts of theft, it makes you aware of it. And you can put in controls or try to find out what happened. And also it allows you to set the inventory balance to what it should be. So, especially around the end of the year, companies would always want to do an inventory because it would basically set their inventory balance to what it should be. Because think about it, things like theft or damaged merchandise sometimes do not get taken out of inventory. Only account and kind of setting the inventory balance to what it should be will reflect the proper inventory balance for a company. So periodic inventory accounts are a great way to do that. Now, substantive procedures. Look for open purchase orders, unmatched receiving reports, unmatched vendor invoices, the accounts payable trial balance. And you would look at that trial balance and everyone that you owe money to and compare that to the control account, which is the control account would be what showed on your financial statements. The purchases journal and the fixed asset report. Purchases journal is just a list of all your purchases during a period. It would be from the purchasing department. The fixed asset report, most companies about once a year do a fixed assets inventory. And what they would do is they basically just go to their locations and they count the fixed assets. Now, fixed assets would be everything such as vehicles that the company owns, computers that the company owns, desk, furniture that the company owns, all of that um, would basically be a fixed assets of the company. Now, the completeness assertion here would be search for unrecorded liabilities, including examine open and purchase orders and looking for unmatched receiving reports and invoices. Again, completeness assertion is a big thing you're looking at in terms of this cycle. Now, property, plant, and equipment and intangible assets, fixed asset inventory you'd want to look at, was it done? Was it completed? Goodwill, examine for valuation, which would be impairment. Is goodwill impaired or not? And this would also be with other intangible assets or other um, property, plant, and equipment could be examined for impairment as well. Amortization, was it amortization and depreciation? Were they calculated properly? A lot of times auditors will do sample tests to see and just recalculate depreciation, recalculate amortization to determine, this is a good way to determine, are some of your assets properly valued or showing the proper valuation on the books? And with property, plant, and equipment, is it owned? Do you have the rights to it? You would look at, you know, for example, inventory, and is it inventory that you have or is it on consignment? Again, this would be a question you would look at as the auditor. And with property, plant, and equipment, you would look at it some to see, is it a leased asset or is it an owned asset? You know, so again, kind of another thing you would look at here as an auditor. Now, audit risk model applied. So what this kind of means is that this is kind of looking at areas of possible fraud in relation to this cycle. So these are excuse me, these are audit items that are usually examined by a CAT system. Remember, computer aided audit technology. Now, so what you're doing is you would run a program, and typically you would use the two probably best known CAT systems are IDEA and ACL. And you would run this through your client's accounting information system, and you would look for certain things that could indicate fraud within the accounts payable or purchasing systems. So you would inspect invoices for photocopies, because if you're going to change an invoice, a lot of times you're going to make the change and then make a photocopy, and the photocopy makes it harder to tell that there was actual change to the initial invoice. Inspect invoices for always round numbers or even numbers. Again, fraudsters have been found to tend to use more even numbers with their invoices. Inspect vendors' invoices slightly below inspection levels. So, what if you, as an auditor, will only inspect invoices less than or over $5,000? So, what you want to do is you want to then run something that maybe looks at any invoices over 3,000 to see if there's a lot of invoices within just under your threshold for inspection. Scan invoices with only a PO box, post office box. Again, in the past, this has been found to be a sign of fraud, or basically what you're looking for a lot of times here are fake vendors. And a lot of times this might be set up by an employee to where they're getting the checks, they're working as a vendor kind of, and they're making money off the company by overcharging them. But again, a lot of them will use a post office box. They don't have a physical location to do business with. Look for vendor invoices with no phone number. Again, just an odd thing, but it could indicate a fictitious invoice. And match vendor invoices with employee addresses and phone numbers, because a lot of times fake invoices will be a scheme basically generated by an employee. Again, where they've set themselves up kind of as a vendor, almost trying to do business with the company, but they're not really giving the company what they want, but they're accepting payments from the company or submitting invoices to the company. And if those addresses are matching, then again, that could be a sign of employee fraud. So that kind of sums up chapter 8. Thank you and have a great day. Bye bye.